2018. Let's ask Chakri Lokapriya, Managing Director at TCG Asset Management, joins us on the show. Chakri, good having you. Thanks so much for joining in. Not a bad start. The last 2 days have been a bit quiet, but do you believe earnings will set the stage?
Good morning. Yes, 2017 was largely a year of belief in life after demonetization, belief that GST will be implemented, and belief that earnings growth will kick in. And now this year, after I think probably about 4 years, in this quarter, you will see probably the highest revenue growth, which is about somewhere between 12 to 14%, and a higher earnings growth. So if that sustains, then you can say this is probably sustainable and therefore will improve over the coming quarters.
So, world over, probably there is optimism with regard to the economic growth, and that's probably a key reason why commodities are doing well, and so are commodity stocks. Do you think that could be a big beneficiary that could throw up earnings surprises?
Yeah, absolutely right. In fact, one of the things that has been holding up Indian corporate earnings is exports. Now, if you look at the PMI, which was a positive surprise a few days ago, and if you look through those numbers, it was largely led by a lot of export related, which was also reflected in higher port volumes. And so this trend is likely to continue because, whether it's US going to reduce tax rates, because it's not yet done so, it will happen only in 2019. So which means that will create a new leg of growth for commodities because of infra spend, etc., corporate spend, capex spend. And so you can see that there is a sufficient demand for commodities, not stocks, the underlying commodity metals, for a fairly long time, i.e. at least for the next couple of years.
So what do you really like? How do you play this?
I think here in this quarter we will see the strongest earnings growth coming from metals, largely export. Indian demand is yet to pick up. Second, you will see a very strong number from cement. When I say very strong, I mean after years of very low number growth, slightly more positive numbers from cement, and as well as from banks and NBFCs.
Okay, let's talk about 2 or 3 of these pockets. We also have a story coming up on Bhushan Steel, and we'll just refer to that as well in a bit. But firstly, telecom, because that's in focus today, as also focused for the last 2 or 3 days, to be honest. Geo tariffs. Today, I think, or last evening, the Telecom Commission has accepted TRAI's proposal to raise the spectrum cap as well. What do you do with the incumbents? And let's leave Reliance out. Talk about Bharti and Idea. What do you do here, Chakri?
The incumbents have had their fair share of, run up in stock prices, but that doesn't change the fundamentals of having very high levels of debt. Now, if you look, all that this new spectrum rules have done is increase the tenor of repayment and reduce a little bit of interest payment. World over, if you look at spectrum prices, which when they're awarded by the government to any company, are at a far lower price than what the Indian government has done. And whereas the Indian, per minute charges are the lowest in the world. So right there you have a big business model mismatch of you have high capex costs and low revenue. And on top of that, you're now trying to regulate it, saying consumer and all that good stuff. Against this backdrop, don't see balance sheets improving in a hurry, at least in the next several quarters. Stocks have done their bit of run up, so there might be a small trade here, but outside of that, nothing much more.
Okay, so that's on telecom, maybe a short trade, if at all, nothing more. You mentioned cement. Interestingly, we've seen almost all cement companies have a fabulous run. I mean, Shree Cement is knocking on the doors of 20,000. Maybe ACC Ambuja not so much, but the others, the mid-sized cement names, Sagar Cement, Sanghi, etc., all of them doing well. What is your view here? And is there anything that you guys own in your fund or, like from an ownership perspective?
I think we'll now increase our positions in cement, and this will be right from the Sagars of the world are the very small, illiquid ones because you can't really buy them in size. On the other hand, the JK Cements, the Heidelbergs of the Heidelberg is another example. I think they're still sticking with very low capacity utilization. Demand is just picking up. Pricing power is really not there. You've seen the first quarter of volume growth happening. Now with Bharatmala, wherever it rolls out, begins to roll out, you will see hopefully see increased demand. So against these expectations, cement stocks have done well. And I think after several quarters of very low volume growth, for the first time in this quarter, we'll see a higher, volume growth.
This morning, Chakri, we did a hypothetical scenario gazing of what it could mean for the Monet Ispat shareholder if indeed this were to go through. I mean, the bid that the JSW has put in. I think there is enough and more reason to believe Bhushan would face enough interest from both Tata Steel and JSW because of the eastern presence that it has. I don't know how closely you've looked at these stressed assets, and the question is what it would mean for the eventual suitors as well, and whether this bullish cycle could take all of these stocks higher.
Haven't looked at this particular transaction in great detail, but I think it's a combination of two things that is happening, will happen with all these various stressed assets. One is the amount of haircut will probably be about 50 to 65%, and second is whatever equity is left. And then as a part of that, and you're fortunately in a point in time when the demand is increasing for metals, and so this gives them sufficient, hopefully, time to have earnings which will start repaying because even after the debt resolution, there'll be still a fairly high level of debt for any company, for any acquirer, and so they will use some of these tax loss forwards to carry them forward and then improve earnings 3 years out. So from that perspective, what it is increasing a market share rather than earnings in the first instance.
So several traders in particular have been trying to buy into some of these stressed assets or stressed companies, so to say, like Bhushan Steel or Monet, or even other stressed companies which have high leverage like GMR, GVK, and all these companies are trying to kind of deleverage and resolve and sell assets. Do you really see an opportunity here in some of these names?
Yes, clearly there is an opportunity, but again, when you're buying into one of these companies in hope that a deal will happen and a stressed asset will be bought out, that is probably a more dangerous strategy for the uninformed investor, or at least working out of just newspapers, because a large amount of financial work detail which is not available because these companies have been stressed for the last couple of years. So that requires a large amount of analysis, but there is value out there, and because the NCLT and the various laws, the bankruptcy laws, you're taking haircuts of up to even 50-60%. So after that, I think there can be viable companies, and therefore the stock prices have some room of upside.
Okay. The other phenomenon across the world, we're seeing yields move up, right? US yields, I think, inched up quite dramatically. I think from what I read right now, our 10-year bond yield too has gone up to 7.43 now. There's a 6 basis points rise in the bond yield, 7.4230. How does this augur for NBFCs which have had a really good run? The argument, of course, is the long end is going up, the short end isn't quite, but we had Equitas the other day come and say that it will impact their borrowing costs nonetheless. What is the equity call on NBFCs as a result of what's happening to bonds?
The equity call on NBFCs is there will be some amount of stock correction because
correction, you're saying?
Correction will happen simply because the valuations have been high. On the other hand, one can argue that that as bond yields go up, that as an asset class becomes less attractive, and overall money flows into equities. So when that happens, whether it comes to NBFCs or not is a completely different question. So for equities as an asset class, it's positive. For NBFCs, the valuations are high for some of them. Obviously, things like Magma Corp, which somebody initiated with a buy.
IIFL today initiated with a buy.
It's a fairly low valuation. It's like some 1.3 times book. So in those kind of cases, I think valuation is on their side.
So what about equities, Equitas and Ujjivan Financial? There too, I think valuations are fairly reasonable, if I'm not wrong. Have you looked at them?
I haven't looked at them in much detail, but Ujjivan is coming off a huge post-demonetization kind of thing. So what you will see in earnings is not the normalized earnings. You'll see really big numbers. But how they normalize out is more than 2 years out.
Okay. But banking sector or Nifty Bank in general has been underperforming the index. It has not yet hit the new high. Do you see that trend continuing even after the Q3 earnings?
I think one of the main reasons banking sector has underperformed is because of the spate of QIP, IPP announcements. So so you have the major institutions which are waiting by the sidelines, saying that they'd rather participate in an institutional placement and in a QIP. And so I think that is one of the main reasons. And second is now this quarter earnings will reflect a convergence. Investors would like to see in this quarter, what is the convergence between NPLs, reported NPLs, and post NCLT? There should be a convergence between book value and adjusted book value. I think, but if you want to buy it for a 1 year out or 2 year out, I still think you can just go ahead and buy banks.
Okay. Chakri, I will leave it on that note. Thank you so much for taking the time out and joining us, and have a good week ahead.
Thank you.
All right, that's the view from Chakri Lokapriya of TCG. The market